You've reached the stars. Now let's see you conquer galaxies.
Good morning, everyone, and welcome to the 2021 Economic and Market Outlook, titled Bracing for a Different Future, and organized by Meristem Securities Limited. We are the distinct and preferred financial services provider with up-to-date market information to grow wealth in good time and in an atmosphere of transparency. My name is Ifnayo Biora, and I'm the moderator for today. We have two knowledgeable panelists who will take us through the economic and financial market outlook. As they make their presentations, please feel free to type your questions in the Q&A chat box. They will be answered by the panelists during the Q&A session. Lastly, this event is being recorded and you can visit our YouTube page to watch this event afterwards. Thank you for joining. I would like to introduce our first panelist, David Adu. David Adu is a senior research analyst at Meristem Securities Limited. He leads the macroeconomic team and has primary equity research coverage over the banking and telecom sectors. He holds a bachelor's degree, first-class honors from Samuel Adeboyega University. Furthermore, he has an economics and international business certification from International Business Institute and is currently enrolled in an MBA program at the University of Suffolk. He's a certified advanced financial modeler from the Financial Modeling Institute and a member of the Chartered Institute of Stockbrokers. He possesses strong quantitative and analytical competence and is proficient in macroeconomic analysis, business strategy, financial modeling, and financial markets. Please join me as we welcome David Adu for his presentation.
Good morning, thank you for having me. Just as mentioned, I will be taking you through our Outlook presentation this morning. And like as we mentioned, our Outlook presentation is titled Bracing for a Different Future. And what we've prepared for you this morning is we've looked at the broader economy, we've looked at the global economy, and we've also looked at the domestic economy. And what we've been able to put together for you is a key collection of the key events and the key things that are set to impact the economy in 2021. So I would like to welcome you once again as I take you through this presentation. Thank you once again. I apologize for the delay. I seem to be having a bit of laptop issue, but I think that has, cleared itself now. So let's dive straight in. So like I said, we've looked at the key themes that are set to impact the markets even in 2021. And undoubtedly, one of the key things that has, changed the state of the global economy is COVID. Ever since we had the first occurrence of COVID from late 2019, the COVID-19 pandemic spread all through the economy. And by early 2021, the WHO declared it a pandemic. And this right here, we're looking at the global situation reports of how the COVID pandemic has evolved. And we can see right here that as of yesterday, we have about 92 million cases, with the bulk of it being centered, in the US and Brazil, India, and Africa. US, Brazil, India. And you can see for Africa that we have just about 3.1 million cases, which makes up around 3% of, the global cases worldwide. And what we've seen is that the widespread nature of the pandemic caused a very massive shock to the global economy. And what we eventually started to see was that even across the world, we saw a host of economic indicators reach historic lows. According to the World Bank, they've mentioned that the pandemic is set to trigger even the deepest global recession since the World War II. And for the first time, we are starting to see a situation whereby a host of economies are going to enter into a contraction at the same time. Now, the positive, as you can see from the chart by the left, the positive is that from that initial shock that was witnessed around March, April, we started to see gradual reopening of the economy, and that was because there was sort of some improvements in the health system. We saw the introduction of social distancing measures and the introduction of using of masks to help control the spread of the pandemic. And that's all those measures provided a platform for which the economies can gradually start reopening. And what you see here is that from June, July, from the second quarter when the economies around the world started to reopen, global growth started to pick up. But then again, we've seen from data from recent times that the gradual reopening of the economy has sort of led to a rise in cases once more, and we've started to see even a second wave of the pandemic start to take hold across regions. And if you look at this slide, what we've done is to just do a pictorial representation of how this has evolved even in key economies around the world. Look at Germany, Italy, UK, the US, and the likes, and you see that we are starting to see even that second hold take place. So that means that the implication of this is that as long as the virus continues to spread, as long as we're going to continue to see new cases, spread across the world, the strength of the post-pandemic recovery is going to be very, very uncertain, because as long as the virus persists, we are not going to have a full reopening of the economy. We're not going to have, economic indicators move back to even pre-pandemic levels. So, and these were some of the things that we talked about in our half-year outlook. So, which brings us to the point whereby we start to look for vaccines. And the thing about the vaccines is that they were generally not expected to come into, they were generally not expected to become widely available until, sometime early this year or, mid of 2021. This is because of the, the long process that typically, drug, that the long processes that is required for the clinical, development process. They have to go through, phase 1, phase 2, phase 3 trials before they get drug approvals. And some instances, this can take up to 15 years. But what we've had this time around is that governments, private institutions, multilateral agencies across the world have worked, around the clock to ensure that we're able to get vaccines in record time, and also vaccines that are effective and are safe for use. And this, what we've done here is we've mapped the global, efforts as regards the vaccine development. And you can just see the snapshot here that shows us, the different stages that the vaccines are at. And as we speak, at the moment, we have 9 vaccines that have been approved for use, in at least one country. So moving forward, news about the development of the vaccines. Naturally, they present a positive boost to the economic prospects in 2021. And this is largely because once we have vaccines that are effective, we're able to, get back to we're able to supposedly get back to, the way things were before the pandemic hit. But what we've been able to do is to actually look in depth at, the entire value chain, the entire system, and from what we've been able to discover, we found that, development of the vaccines is just one stage. The next steps which involve manufacturing and also distribution of the vaccines are going to be the next. They're going to present even new challenges as we progress. Now, we looked at the global population is 7.8 billion people, and all experts have mentioned that we require to. It's at least 70% of the population needs to be vaccinated. They need to be immunized before we can achieve herd immunity. And herd immunity they define it as when enough people have gotten the immunity against the virus, such that the virus is no longer able to spread as rampantly as it should. Now, one of the peculiar things about the vaccines that have been developed is that a host of them require 2 doses. So when you consider that and the total number of people that need to be immunized to get to herd immunity, we're going to be talking about 11 to 15 billion doses of vaccines that need to be manufactured and distributed to the end user before we can achieve this herd immunity benchmark. With that in mind, we looked at the manufacturing capacity of the approved vaccines so far. And after getting an idea of all the vaccines that have been approved, announced manufacturing capacity comes to about 6.8 billion doses in 2021. So that's AstraZeneca, CanSino, Sputnik 5, the Pfizer and BioNTech's version of the vaccine, and also looking at the others. So when you combine the announced manufacturing capacity of these manufacturers, we have a situation whereby in 2021 they are only able to supply 6.8 billion doses, meaning that this doses is only able to immunize just about 44% of the global population, which is below that herd immunity benchmark. And also when you consider that a number of the vaccines rather, they require cold storage. They require cold storage for them to be, for them to maintain effectiveness. You now get the sense that this is going to be, even much more challenging, particularly for countries in sub-Saharan Africa, low and other low income, countries that don't have enough infrastructure to be able to support, the logistics of this, of moving these vaccines. And the WHO has already estimated that about 50% of vaccines are wasted every year due to a lack of temperature control, which, adds another, dimension of, risk to the outlook. With this in mind, we, even if we assume a best case scenario where there's an 100% vaccine production capacity utilization in 2021, and there are no production or distribution losses, we would not realistically be able to achieve that herd immunity benchmark in 2021. The best bet would be sometime around mid or late 2022. But then again, in the real world, the production losses actually do occur, and also distribution losses and all that also occurs. So we have a situation whereby a much more realistic time frame for achieving this herd immunity benchmark might be sometime around mid 2023. Considering all the factors that we've laid out earlier. So with that in mind, we now turn to the global economic outlook for 2021. The IMF and World Bank have already revised their forecast for the global economy in 2021. The IMF, expects that there will be a recovery of about 5.2% in 2021, and some of these their assumptions or their forecasts are premised on slightly better than expected GDP results from the second quarter, and also a continuous implementation of the social distancing and safety standards that have been enforced, which should support the gradual reopening of the economy, and even keep this prolonged for a sustained period of time. Now, with this in mind, there is also that factor that we now need to consider, which is that the vaccines in themselves the development of the vaccines in themselves, while they are good, they do not instantaneously solve the problem, because there's still a long process that needs to occur before we get enough people immunized to be able to get the benefits of the vaccine. So from our own end, we think that the risks to this forecast are even a lot more pronounced now. And we've already started to see this play out in 2021, where we've seen countries across the world start to impose some form of lockdowns and restrictions, even in their domestic economies. We think that the risks still loom large, and some form of we think that the risks still loom large, and obviously we would have we'll have a case whereby governments around the world would need to prioritize health safety over total economic recovery. And should also add that a lot of the data around the vaccines about how effective they are is still in development, because it is unclear if the vaccines that have been approved actually provide long-term protection against the virus. That is still unclear. It's also unclear if even these people that have been immunized, can they also transmit the virus? That is still unclear. And when you also add into the fray the new strains that have been developed, and the new strains that have been discovered rather, and to be much more infectious than the previous one, you have a case whereby the global economy is not really out of the woods yet, and we'll still need to emphasize on health safety, and that will continue to limit how strongly the economy will recover even in 2021. And one of the things that we usually see is that when in domestic economies, when you start to see cases spiral out of control, one of the first casualties are always international travel, and school closure, and public event cancellations, and gathering and movement restrictions. So this is usually the pattern that governments across the world take whenever they are trying to manage the rising cases of the coronavirus in their economies. And as such, you can expect that this holds negative implications for these particular sectors, for international travel, for hospitality and other non-essential sectors that require a lot of physical contact. The fact that the COVID pandemic is still very much with us means that they will continue to the outlook for them will continue to be pressured by the COVID pandemic. And also behavioral changes enabled by technology would likely persist even after the pandemic. Take for example work from home telecommuting and all other likes that have been enabled by technology, means that even after the pandemic, we're likely to see these trends be sustained, and that will affect the kind of future that would eventually be looking at once the virus subsides. Then we also looked at a situation that is currently ongoing with the whole vaccine distribution process. And this is very, very important because our initial forecast was saying that, by mid-2023, we would have a case whereby, the vaccines will be well distributed across the world. And that was based on equitable distribution. But what we have ongoing right now is the case whereby we are seeing the wealthy nations crowding out, the less wealthy. About According to data from the Duke Global Institute, um, they've been able to capture the total number of doses that have been pre-purchased under current by governments and agencies across the world, and we've had that already 8.6 billion have been pre-purchased, and 4.12 billion of these have been bought by wealthy nations, which contribute just about 15% to the global population. We have instances whereby, if you look at the map here, we have instances whereby some countries already have they've pre-purchased vaccines to cover about 100%, 200%, up to 600% of their population, crowding out available vaccines for the less wealthy nations. And what does this mean? This means that the economic the strength of the economic recovery of these nations that are able to purchase the vaccines will be a lot stronger than those that have been unlucky enough. They've been less lucky with purchasing the vaccines, and this is also set to impact the nature of the recovery that we're going to see, and it's going to make it slightly tilted more towards the advanced economies, where you have them recovering quicker than the less wealthy nations. But that is not the only development that we're seeing, and we've also seen that some emerging markets are using different strategies to position themselves to get to position themselves at the front line of the vaccine queue. And we've seen that for some emerging market economies like China, Russia, India, they have domestic vaccine development capabilities, and that will help them to be able to produce enough to meet their domestic needs. We have some emerging markets like India as well, and Brazil using their stance as manufacturing hubs for manufacturing hubs for these vaccines to also negotiate vaccines for themselves, while others like United Arab Emirates, Peru are using their stance as clinical trial sites to negotiate deals for themselves, which leaves those that are unable to meet any of these criteria at the mercy of initiatives like the COVAX initiative for that has been set up for equitable allocation of vaccines across the world. Now, moving on, we know that yes, the coronavirus pandemic really impacted the global economy, and it's important to know that without the support of government, it could have even been worse, because we've seen that governments across the world delivered record sizes of stimulus to be able to support their domestic economies even at the heat of the pandemic. But these are, from the fiscal perspective, this has come at a cost for public finances, and we've seen a trend whereby we're seeing wider fiscal deficits across the world, and also higher public debt levels. IMF expects that global debt will reach a record high of approximately 100% of GDP in 2020. But the argument still remains that policy support is still very much required, chiefly because without it, it will help. With the policy measures in place, it will help to reduce the number of people that fall into extreme poverty by about 20% to between 80 to 90 million, which is still a large number anyway. But without the fiscal support from governments across the world, a lot more people would fall into poverty. Then other global key themes that are also set to impact the world economy in 2020, we looked at the monetary policy stance across advanced economies, and those are set to remain largely dovish, largely accommodative across board. We have cases whereby policy rates are near zero, and these are expected to remain even lower to be able to sustain domestic growth across their respective economies. Also, emerging markets are also likely to follow suit and keep policy rates, at levels sufficient enough to be able to support economic growth. Oil prices, we expect oil prices to, continue on a slow and steady pace of recovery in 2021, fueled by, gradual recovery of demand as, more and more people get the vaccines, and then economies gradually begin to reopen. But then again, just like we've mentioned earlier, the dynamics around this are still very, very much very much pressured by the speed of how manufacturing capacity is able to meet the demand. Then also in the geopolitical space, we've seen the change of guard in the United States, where the former Vice President Joe Biden has taken over from. He has been elected as the new president of the United States, taking over from Donald Trump. And his election into that office, spells, a lot for a lot of their, key for a lot of the key for it spells a lot, it spells a lot for their key relationships with trading partners across the world, China inclusive. Then also finally, the UK completed its they were able to negotiate a post-Brexit transition deal, such that they've been able to gain full independence from the European Union. And that is also another theme that is set to impact the global economy in 2021, as the UK begins to look at the next steps of negotiating necessary deals with other important trading partners, and they begin to march towards their post-Brexit future. Then AFCFTA is another key theme that we've also recognized as something to watch out for in 2021. The AFCFTA, became operational at the start of the year, and is set to create a single market, combine all segmented markets, segmented regions in Africa into one single market, and help to support growth, support inter-African trade, reduce tariff and non-tariff barriers to trade, in Africa, and help, channel that next level of growth in the African continent. So that's a brief summary of the key themes that are set to impact the global economy. And now we move to the domestic economy. Looking at the domestic space, what we've seen is that before the advent of COVID, the domestic economy was on a painfully slow growth path, averaging about 2% per quarter, which is, when you compare that with the rate of population growth, is not optimal for an economy of Nigeria's size. So what eventually transpired when COVID hit the domestic space was that it amplified some of the weaknesses that were already existing. And from the oil sector, what we saw was that it was one of the main casualties of the advent of the pandemic, with the impact on global oil prices, and also the global oil price wars that eventually led to production rationing for OPEC members. So what we've seen is that a combination of both weak oil prices and weak oil volumes have led to the crash that we've seen in the domestic oil sector. And also, when you look at the fact that the lockdowns that were implemented, were severely affected the economic nerve centers of the country. Then you begin to get the sense of, the magnitude of how the pandemic really impacted the domestic space. We look across the sectors and we see how these sectors have performed year to date. And we've seen that, some of the worst hit sectors, quite rightly, has been transportation and storage, education, real estate, construction, trade, and the likes. And we've seen that for the sectors that have performed quite well, the financial and insurance sector and the ICT sector. ICT sector and also the agricultural sector inclusive. Those are some of the key, sectors that have been able to weather the storm quite well and recorded growth even despite the spread of the pandemic in the domestic space. For 2021, what we see is a host of different factors that are set to impact the economy even this year. And chief of that is the fact that we are still very much experiencing the COVID pandemic. And what you can even see by this chart here is that the second wave of the of daily cases is starting to spike now, and it's even higher than what we experienced at the first wave. Total number of cases now have risen to about 90,000, and deaths at over 1,000. Not also bearing in mind that in real practice, a lot of the actual numbers would actually be more than this because of our low testing capacity. So we're not even able to test as much as we should, because if we're able to do that, the figures will show us that probably even the number of cases are a lot more than this. So what does this mean? This means that the fact that we are still having this occurrence of COVID would continue to impact how well the economy, particularly those sectors that have been badly hit, how well they recover in 2021. Yes, we expect that the economy will return to growth in 2021, but the nature of that recovery is highly uncertain. On the plus side, the low base effect from 2020, as well as the loss of productivity, triggered by the lockdowns, are strong positives, for a swift return to growth. But the recent surge in the number of cases adds a layer of uncertainty, because while we do not really expect that we would see complete national lockdowns to the extent that we saw in early Q2 of last year, the risk still remains. And in our base case scenario, we factored in that we can get a situation whereby some form of restrictions come into place. Already, we're starting to see some signs across the domestic space that some sectors are not fully expected to recover as well as they should, as long as we are still seeing COVID cases spiral across the world, across the country. So after looking at, after comparing the different scenarios, we arrived at a real GDP growth rate of 2.33% in 2021. Moving forward, some of the other things that have stuck out in the domestic space has been the continuous uptrend in inflation, and this has even taken hold ever since that decision to implement the closure of the borders. And we've continuously seen consecutive months of uptick in headline inflation, and one of the chief drivers of this uptick has been the rise in food inflation, and not just because of the closure of the land borders, but when you add into fact some structural inefficiencies that have plagued the that played, food production, like, insecurity in food producing regions, low productivity, lack of storage, and also high transport costs. I think what we saw even from news, from data released by the MBS, particularly towards the tail end of, towards the middle to the tail end of 2021 and 2020, it showed us that transport, the rising transport cost was also another was also another chief contributor to the rise that we've seen in both food inflation and also in headline inflation. Then when you add on the core index to look at the hike in VAT, the increase in electricity tariffs, and also the higher retail fuel prices, those were the chief culprits behind the continuous uptrend that we're also seeing in core inflation as well. So our outlook for inflation, still remains on the upside. And yes, we admit that the reopening of the borders, will eventually help to stem some of the food pressures that we've been experiencing. But the nature of how that will work still remains particularly uncertain because of some of the provisions that the government have still left in place with as regards importation of some of these food items. Another by the time we look closely at the other key factors that are behind the rise in inflation, at the end of the period, we expect that inflation will average about 15.16% in our base case scenario. In a bull case scenario, we would have 14.97%. In the bear case, it will even rise. Average inflation for the year would even go as high as 15.31%. We look at the balance of payments and the exchange rate, situation of the country, which has really felt the impact of the coronavirus pandemic. What we've seen is that since the advent of the pandemic, we've seen a continuous decline in the trade balance. And if you look at the chart here, we've now, for the first time in a long while, we're experiencing trade deficits for 4 consecutive quarters. And not only that, we've also seen that the magnitude of the deficit is even much larger than what we witnessed, during the crisis of 2016. And historically, the trade balance is one of the accounts that has supported, the strength of the current account balance and has helped to pull it in the positive direction. But ever since we've witnessed the weakness in oil prices, invariably, impacting the trade balance. What we've had is that it drags our current account balance into a negative position, and we start to witness exchange rate pressures. And when you look at the capital account and you see that as at the third quarter of 2020, capital importation has returned back to 2016 levels, then you start to get the sense that the picture is really not, not rosy, particularly when you're looking at the exchange rate situation. You have, from the current account side, you're unable to earn as much dollars, and from capital imports, we're not attracting as much foreign currency into the economy, which is one of the key factors that have impacted the exchange rate environment in 2020. So if we looked at data from NBS, and it shows that the dollar receipts have dropped materially by about roughly about 60% quarter on quarter and year on year, followed by the drop in export and remittances. Then when we look at transaction volumes, they've also fallen. So when you look at this, you immediately get the sense that, lack of liquidity has been one of the key themes that have, trailed the FX space in 2020, and data from the FMDQ also, corroborates that data, that trend that we've seen. And as we speak, the transaction volumes have not recovered back to, the levels that they were. And eventually, what the CBN had to do was to, yield on currency devaluation and also introduce a number of FX demand management tactics. So what are we seeing for exchange rate in 2021? We see that under our base case scenario, we will most likely witness another devaluation in the exchange rate if, some of all these things play out, even as we've mentioned. Oil prices remain at the levels they are, and we start to see even the current accounts, the current account balance remain in the deficit position, and foreign capital, inflows don't improve. We will most likely see another round of devaluation. In the best case scenario, we have it at 360, driven largely by recovery in oil prices, and at 420 to 470 if new pressures intensify, in the global economy. So I think that rounds it up for my section on the global economy and domestic economic outlook. Thank you, for your time.
Ahmed Jinnah, the head of investment at Meristem Securities Limited. His experience in valuation of private and publicly listed companies across a diverse range of sectors such as consumer goods, agriculture, industrial goods, and insurance. He's also skilled in microeconomic analysis, financial modeling, and investment analysis. Before joining Meristem, Ahmed worked as a project monitoring and evaluation analyst for Lagos State Commercial Agriculture and Development Program, a program of the World Bank. Ahmed holds a bachelor's degree in agri-economics from the University of Ibadan, where he completed his master's program in the same field. Okay, Ahmed, you have the floor.
Okay, yes, thank you, Unaya. Okay, so I'll run us through the capital markets, look at the equities markets, fixed income, and alternatives. Thank you, David, for your presentation. You've spoken to a lot of things that forms the backdrop for our outlook for the market in general. I'll start with the equity market performance across markets. I mean, the COVID-19 pandemic remains a recurring theme that's had perhaps a very similar impact on our market performance across the world. And as you can see on the slides, you will see that the trend, the trajectory of most of the equity markets from across the world trended a similar path, although to varying degrees in terms of their performance. But overall, we saw an initial weak performance, I mean, at the outset of the pandemic, and then a broad-based recovery across most markets. In the Nigerian markets, we can see the monthly performances of the all-share index recovering from the initial dip in the markets. We saw in February a decline of 9% and followed by another decline of 19%, both due to the pandemic and of course the problem that it created in the crude oil markets. And then subsequently we can see how the market has recovered from all of that shock. Now, what are some of the things that drove the performance of the market to the position of being the best performing market in 2020, having returned about 50% from where it closed at in 2019? One of the first things that I think perhaps every investor that played in the market last year, what stood out was the very low yield in the fixed income market, which means a lot of investors had to rotate funds into the equities market. So we saw some strong participation from domestic investors and even institutional domestic investors. Okay. Like we're saying, despite the extended rally, it wasn't a rally that lifted everyone in the boat, as the caption implies. Apart from the industrial goods sector, the insurance sector, and the banking sector, we can see that the oil and gas stocks as well as the consumer goods stocks didn't perform as so well. And this reflects the underlying conditions in those sectors. With the oil and gas, we're all familiar with how bad things got in the crude oil market, even with oil futures trading briefly at a negative level at some point. Even though we expect recovery in that area now, but the performance in 2020 reflected that underlying weakness, even for the downstream sector. Despite the deregulation, it didn't really help business, given the fact that there was FX scarcity for many of the downstream players to import directly. So there are still underlying fundamental issues, which was reflected in the performance of the market. Now, having looked at what has gone now, I know what we are here for is essentially what do we expect in the market, and this is one of the most exciting things for analysts to do at the start of the year. So we won't shy away from the truth. I think the first thing we need to highlight here is the fact that the market is indeed, according to our technical indicators, the market is indeed overbought, which means we can expect a correction in the future. But beyond the technical, I think one of the things that we also have to pay attention to are the major drivers, which goes beyond the fundamental, like I mentioned earlier. One of the main driver of the market performance from last year was the excess liquidity, low return in the fixed income that I mentioned, and we expect this to continue. So despite the fact that we think the market is overbought, I think that those drivers still remain relevant in the market, and we expect that to continue sustaining the positive momentum of the market for at least the first half of the year. We've also taken a comparative or what you call a relative valuation of the Nigerian market when you compare it to its peers in sub-Saharan Africa and the emerging markets in general. And you can see from the charts that although we say the market is overbought, but it's still trading at a premium to the average in frontier markets, the average in emerging markets, and you can see relative to the South African market, even though it is more expensive when you compare it to Egyptian and Kenyan equities. So where does that leave us? What should we expect in 2021? And these are the main factors that we feel will impact the performance of the market. And down the line, I'll tell us what strategy we think we should use to play the market in 2021. Like I've mentioned system liquidity, I've mentioned fixed income yields. I think what is very relevant, especially at this time now, because if you have to take action, I think now will be the best time, is the hunt for dividends. Even at current prices, dividend yields on many of the aristocrats are still attractive, and we feel that will dominate the direction of the market, at least through the first half of the year. Also, corporate earnings, they were resilient in 2020, despite the pandemic. We didn't see the kind of weak performance that we thought we would see initially in the markets. I think some of those, many of the companies actually demonstrated resilience in the market, given the results that we've seen so far at the third quarter of the year. So this is one other thing that we feel will sustain positive sentiment in the market. On the downside, however, the FX market and foreign investor activity, we still expect foreign investors to stay on the sideline, and that is informed by some of the events that happened in the market last year. A lot of the foreign investors could not exit due to the management of the FX by the CBN, and so that creates a liquidity issue for the market. Let's also not forget the fact that sometime last year, the MSCI, which is a provider of global indices that are tracked by fund managers across the world, classified the Nigerian market. Stated that it won't be implementing any changes from the rebalancing of the MSCI Nigeria index And what that means is that for many global fund managers across the world, when they rebalance the index, most of the time you have some equities drop off, some will need to be included, and of course that will drive trade in the market. So the fact that they will not be implementing that means we can expect many of the global fund managers that track that index not to take action based on the outcome of the index review. So that is on the downside. And of course, it is informed by the FX scarcity that we have, which we feel will, to a very large extent, will be determined by the outlook for crude oil earnings. I mean, it's looking decent now. I mean, there's modest optimism for that right now, but you never know with the oil market, given its volatile nature. So we have that on the downside, and then the other thing that we're looking at and we're seeing as a major downside risk potentially for the market this year lies in the form of a surprise policy change. And I think there's a delicate balance right now. Yeah, I think there's a delicate balance right now. So right now, we have on one hand, inflation that is getting out of control. And on the other hand, we have the Monetary Policy Authority that wants to support the economy. Let's not forget, like David mentioned, we are in the middle of a recession and they want to do everything that's possible to quickly stimulate the economy out of that recession. So there's really tightening, or as we call it, increasing interest rates to control inflation would be counterproductive for their pro-growth policy stance. So which means that that's a variable that we have to watch closely in 2021. And it has the potential of impacting what goes on in the market. Our expectation is that if yields goes up dramatically in the fixed income market, we can expect sell-offs from domestic institutional investors from the market back to fixed income. And of course, that will impact on the performance of the market. So on this slide, I just have a summary of the positives and the negatives that I've just spoken to. In terms of broad outlook for each sectors, we've classified them based on whether it's a strong, low, moderate, or negative. Our position for across the sectors is broadly moderate, except for the consumer goods and the oil and gas sector, where our earnings outlook is really low, and for obvious reasons, like I've mentioned, the underlying business fundamentals are pressured at the moment. I'm being asked to hurry this up. So straight up, we look at our forecast for the market. As usual, we adopted three main methodologies: the fundamental, the econometric, as well as neural network, which seeks, and of course, they have different attributes that makes them great at forecasting a time series of the all share index. Our weighted return for the year is minus 6.09%, but we don't expect, and don't forget, this is full year 2021 expectation. When we get to the strategy shortly, I'll talk about what we feel investors should do in order to outperform the broad market return. Okay, fixed income, most of the events in the fixed income space, I've spoken to them a while ago, but let's just, so that I don't skip it, just summarize what we are witnessing in that market, given the low yields and the surplus liquidity in that market. We've seen a lot of corporate companies, both public and private, even state governments, taking advantage of the low yield to source for cheap capital in the market, and we expect that to continue. In fact, for investors who are looking to include this in their asset class, we feel that for you to outperform the average returns in the market, you must be willing to take on more risk. The risk appetite will have to go up to achieve above average returns. But of course, this will depend on what is the investment profile of each individual investor. So I would encourage constant discussion with your advisors, so that as the market, because the market too is dynamic, a lot of things can change rapidly. So that conversation is important this year, given some of the uncertainties that still lie around. Okay, so what will shape the fixed income market? We already know the monetary policy stance is very loose. There is an argument to be made for an increase in interest rates, but will the will to follow through be there? We don't think so, at least for the first half of the year. So that is one of the main themes that we need to watch in the market, especially because of its impact for the performance of this asset class. Also, the corporate borrowers that have been taking advantage of the market, I think that trend will continue, given some of what we're seeing in the market at the moment. The introduction of the CBN special bills is another thing that should help with the excess liquidity, but the yields on these bills too are really, really low. So we don't expect that to have an overriding change in the direction of the market in this year. Okay, and of course, not to leave out some of the new, I don't want to call them asset classes, a controversial topic, but cryptocurrencies gained a lot of traction from last year, and I think that momentum is still there. From where we stand, we feel that, like I said, it's a controversial topic, whether you consider a cryptocurrency as an asset to be invested in or purely as a speculative currency. Our advice right now is for clients, to fully understand, if you're going to invest in an asset class, you need to understand how it derives its value. When it goes up, what are the facts? Do you have an underlying explanation, fundamental explanation for that, and when it is dropping as well? So for us, we feel that it is still a very, very risky asset class with a lot of it still unknown, especially in our market where you don't have structured frameworks to monitor its trade. So what we just advise our clients is to be cautious. For now, we don't have a recommendation for people to embrace the cryptocurrency, the crypto coins, as it were. So what's our strategy for the year? I know this is what a lot of us have been waiting for. And so what we've done, given our outlook, is to advise that you look at, we've had to do a top-down approach across the sectors to pick stocks with the following metrics, and put that up in a strategic portfolio that is in the main report, and we'll share after this event. And what we've looked at is companies that have at least 3 consecutive years of earnings growth in the last 5 years, the same for turnover growth, double-digit return on equity, and of course, the minimum dividend yield of at least 5%. And we've also considered potential, our target prices for the year and the potential upside as part of the factors that were used to screen these stocks. And so we have that portfolio, and we expect it to return about 27% by full year. The details of this you will get in the main report after this event. For the fixed income market, I think for now, because even if it's for diversification of portfolio, for the sake of portfolio diversification, we know that a lot of investors, we can't shy away from the market, even with the yields. But for now, our advice is that to stay on the short end of the curve, buy short-term instruments, and also to focus on the corporate issuances in the market, which comes at a relatively higher yield compared to the benchmark instruments. And of course, for active traders with higher risk appetite, you can focus on high yield, short duration instruments, which can then be reversed at higher yields if rate reversals does occur in the course of the year. Thank you very much for attending our Outlook presentation today. I think now we would have, I'll let the moderator come on so that we can take questions. Thank you, everyone.
Thank you very much, Ahmed, for that insightful presentation on the financial market outlook, and especially the insight into the composition of 2021 strategic portfolio. Thank you. Okay, we would now go into the Q&A session, and we would start with at least 5 participants who have raised their hands. We will unmute your mic so that you can ask your questions verbally. Abdul Rashid, please unmute to ask your question.
Thank you so much for the presentation. My question has to do with the issue of the foreign remittances. I understand the last, by the record, in 2020, there was about 25 billion foreign remittances. I don't know if Junaid will have spoken to the effect of that on the foreign exchange, and also the Central Bank of Nigeria policy change, which allows for people who those foreign remittances to be claimed in the currency that they are received in Nigeria. So those are the two issues I want Junaid to please start with. Thank you.
Okay, thank you, sir, for your question. So on the first one, the foreign remittances, I mean, and it goes hand in hand with your second question, really. I think the concern mainly from last year was the fact that foreign remittances kind of dried up due to the pandemic, because it was an external shock that affected virtually every economy. So even for those who were, especially in advanced markets, I think they were even more affected with record levels of unemployment and slower income. So that impacted on the volume of remittances. But given that, be that as it may, the new policy from the CBN, which will now allow beneficiaries from those for those remittances to withdraw it in foreign currency, will expectedly reduce the demand that we have in the parallel markets and in the black markets as well. So that should because obviously we know that there are fundamental drivers of the pressure on the currency, but there are also speculative drivers as well. So if people can get their remittances in foreign currency, like the CBN now prescribes, therefore means that you can expect the demand pressure in those markets to reduce, and of course for a more an improvement in stability in that market. But let's also not lose sight of the fact that the remittances is also a function of how well those foreign economies are also doing, because disposable income have been impacted even in the most advanced economies. So that as far as the policy is concerned, we think it's a good one that should ease the pressure in that market, but a lot of it will still depend on how well those economies recover this year, and then the diaspora, Nigerians in diaspora are able to, how much they have in disposable income to send back home.
All right, thank you very much, Ahmed. Okay, we'll unmute Nona.
Hello.
Yes.
Hello.
We can hear you.
I said, therefore, Junaid, I was expecting that the issue of reinvestment of dividends, especially for a number of the multinationals who are not able to raise enough FX for export of the dividends, is a factor that we should also not ignore in 2021. I want to hear your view.
Yes, certainly, and you will see that we expounded on that in the main reports. Of course, it is one of those things that will drive the market. And if you see from what we said about FX scarcity and FPI participation, for us there are two competing scenarios really. You know, our expectation for the crude oil market and consequently export earnings this year is that we expect a recovery in that market. I think the default position of the CBN is to continue intervention in the market and stabilize it. Why they could not do that as much last year was because of the earnings outlook. So the exports FX earnings outlook last year, it seemed like we're not going to make a lot dollar earnings last year, and so it was better. So they had to manage what we had in external reserves, even with all the multilateral loans. So that is a factor. But this year, with current vaccination efforts, which we'll see we expect to lead to a recovery in demand. And even if you look at the crude oil price level in the past few weeks. It's been trading in the $50 per barrel range. And that is even when a lot of economies are still reimposing new rounds of lockdowns. Our view is that by the second half of the year, when we expect some more modest recovery in the crude oil market, the CBN might go back to its more aggressive intervention in the market to stabilize the market. And by that time, we expect some of the FPIs that have been trapped, well, maybe not trapped, that have not been able to exit the market to finally be able to repatriate their funds. And that would definitely, like you said, impact the performance of the market. To answer, to address your view, it's a valid view that we touched on explicitly in the full report. Thank you.
All right, thank you, Ahmed. Hello, please ask your question.
Okay, thank you so much, the moderator. Ahmed, thank you so much for the presentation. It's quite exciting, and I must tell you that I've really gained a lot, and I've also learned a lot. So quickly, to ask my question, I want to ask a question based on the things you said regarding a cryptocurrency space. At a time when the economy is really not doing very well, and a lot of people are actually looking at investment windows where they can have a high yield return quickly. We can't deny the fact that the crypto space has actually shown a lot of traction, like you rightly said. And also given the fact that I'm aware that there are certain pressure from international financial space for Nigeria and other developing countries to actually adopt cryptocurrency and the CBDCs for their, by the central banks. I'm also aware that towards the end of last year, CBN actually set up a 10-man committee to review and advise them on cryptocurrency space, basically, and make recommendations. And if you are following the news, you also know that Elon Musk just invested heavily, as well as other billionaires in the world, into cryptocurrency space. Based on all of these, don't you think that it's a space to actually take seriously and not just disregard it, especially given the fact that you may not be able to have local control or local regulation within that space? I think it's a real asset to look at, digital assets to look at. Thank you.
Yes, thank you for that comment. So you remember at the start of that section, I said, the issue of cryptocurrency as an investment asset is a controversial one at the moment. The fact that a lot of institutional investors are buying the asset right now, and then we also have this fear of missing out. So the rise that we are seeing really kind of is like a self-fulfilling prophecy. We are not saying that we are discounting it or we are totally ignoring it, but a lot is still not understood about what drives the value of that currency. Like I said, it's still very and I don't want to give my own personal view, the school of thought that I belong to. But like you said, it is here, people are using it. What we are just saying at this moment is that it is a very risky asset for now. It's very, very volatile. And from what we know, a lot of investors cannot handle that kind of volatility. And we are also aware that there are platforms that are coming up now that affords you that opportunity. So our advice is just to say that clients need to be cautious about how they play in that space. And general advice for any asset class, really, even for equities, if you don't understand what drives a company's performance or the underlying business model, you should, from what all the greats are saying is, you don't want to invest in it, because if you don't understand the underlying business model, how then do you predict its performance or the direction of its price, and then know how to position. What we are seeing right now is, I think, given the sharp volatility from last year, is that a lot of institutional clients are buying it because they think, or maybe it's a better store of value than fiat currency at the moment. But there's more to it than that, which I feel that a lot of people do not understand. But because we are seeing the high returns, everybody wants to get on the bus. But that too itself could be a very risky venture. So we are just highlighting the fact that it's a risky asset. If you have to do it, you have to do it with caution. Of course, locally, it's not available as there's no, you don't have that framework yet. Of course, the regulatory bodies are looking at it. SEC says mentioned last year that they are considering it as a digital asset, but that the onus of proving that it is not an asset will be on the issuer, and you don't even have issuers trying to issue publicly here in Nigeria, but there are platforms that allow you to buy some of these crypto assets. And so because the way it's still run in Nigeria means it bypasses the regulators most of the time, I think it's just the responsible thing to advise clients to be watchful, because it's a very risky asset for now. I don't know if that addresses
it. Sorry, I'd like to add one more thing to the conversation, and that is on the fact that, even we as professionals, before we give any advice, one of the first things is you look at the client and you ask, what is their risk appetite and what is their ability to take that risk? So from a client perspective, you also need to understand your own situation. Yes, the cryptocurrency, Bitcoin, and all the other, forms of, cryptocurrency, they offer really attractive returns. But at the same time, they can also fall sharply, and might not be able to undo that loss. I mean, just recently, for Bitcoin prices, they crossed $40,000, and then they fell back down to, I think, about $30,000 or $32,000, in a very short period of time. So that kind of volatility really does exist. And from an investment perspective, you need to be able to understand if you are in a position to be able to undo that kind of risk before you eventually decide, okay, this is something that I would like to do. So just like Ahmed has said, we've looked at the entire situation, and at this point, you would look at your position. Do you have the ability to? Do you have the capacity to undo that risk? If you can, maybe you want to look at it. But if you don't, then it's obvious that you should just stick with investments, assets that you are comfortable with and that you understand. Thank you.
Ahmed and David.
Okay.
All right.
Thank you very much. If I might get Ahmed right, he said that he does not know the drive behind the cryptocurrency right now. I would like to come back to our equity market. That please, what can you say is the drive behind the movement of Japan gold at present, that the price is moving up, looking at our own equity market?
Okay. I think that Japan gold used to be Japan oil. So yes. So last year, they had they informed the market that they were looking into gold mining, and of course, given the state of the market last year, where people were trying to, because of the threat of devaluation, and in fact, the actual crystallization of the Naira devaluation, a lot of people felt, it's like investing in a company that is operating in a sector that is much sought after. That last year, apart from cryptos, even commodities that people see as a store of value like gold and other precious metals also appreciated significantly. So, by way of explanation, the fact that the company was changing, was making a foray into gold mining, gives people the sense that, okay, going forward, they'll start doing very well, and might just explain why you have that price appreciation. There is there's an underlying change in the business model that you can assume the market is reacting to.
Sorry, why do you think we should believe them? Because some of us did research on this same company in the past with what we bought from them, and we discovered that they were not producing anything. Now that they are telling us that they are going to good, why should we believe them?
Of course, you don't have. Thank you. Of course, you don't have to believe them. Even Japan Gold is not one of the sectors that we provide coverage on, and it is because of some of these issues. When you have issues that border on corporate governance, compliance, and all of these things, we don't cover such stocks. So it's not like we cover Japan Gold and we are recommending it to clients. But it's just to answer your question in the sense that, okay, what happened with them, you know? So I mean, you don't have to believe them. We don't provide coverage on Japan Gold either.
Okay. All right, Ahmed.
Thank you.
Thank you very much. Thank you also, Afamefuna. We'll take the next participant, Tolu Johnson.
Good morning. Thank you very much, Ahmed, for your presentation. Thank you to all speakers so far. I just wanted to sort of draw you back a bit with respect to your presentation. So I noticed that some of the, in terms of economic outlook, or some of the outlooks that were given, it was more towards like, okay, what's going to happen in H1 2021, or what's going to happen like the full year outlook for 2021. So I'm more interested in like the near term or short term outlook for some of these economic indicators. Perhaps you could just speak to like a few of them. Maybe inflation, exchange rate, GDP, external debts, maybe monetary policy rates. You could just speak to like your near-term outlook for some of these indicators. Let's say 1 or 2 months. What do you think is going to happen? Are you going to maintain your like use, or like just speak to just some of those indicators? Thank you.
Okay, thank you. David, do you want to speak to some of these?
Yeah, let me handle the questions. So when we're looking at broad macroeconomic indicators, just like you mentioned, so ideally what we do in our outlook is we take a longer term view, you know, H1 for some, and, you know, the full year. So that is why, you know, our presentation was structured that way. But to take your question, take, for example, we're looking at an indicator like inflation. And for inflation, you know, we've spoken to some of the key drivers behind inflation that it has been driven by, you know, food inflation for a while, and gradually we're also starting to see that core index start to rise as well. And what we are seeing is that near-term outlook, you know, at least for the early part of 2021, we'll still see inflation trend to the upside. Then gradually, you know, from the middle of the year, when we see the impact of some of these measures, take for example, the easing of the borders and the likes, we see that impact on food prices. You know, it's one of those things that we'll also watch closely. We'll see the impact on food prices, we'll look at transport prices, and if that starts to, you know, improve, then we can start to expect, you know, gradual easing of, you know, we're also looking at how they perform year on year. So you'll see that gradual deceleration in the pace of inflation. Then if we look at something like, say, GDP, for the near term, our expectation actually for 2020 is that we expect, you know, the economy to still remain in recession in 2020, largely due to the factors that we've, you know, spoken about in the report. And also, if you look at, as at Q3, cumulative, I think we're about 2.4, 2.5% in the negative. So, and you look at Q4 performance historically, it has always been, you know, one of the strongest performance, you know, over time. And you look at how Q4 performance for last year was, for example, and you see that the expectation will be that, you know, we might not, you know, that deceleration will still continue even in Q4, because I mean, for much of the first first month of Q4, we had this NSAS crisis, or the NSAS protest rather, where, you know, there was a lot of disruption to economic activity, you know, shutdowns in lockdowns in Lagos, in Ogun State, in in Abuja and the like. So you would expect that that will eventually filter into the data, and sort to contribute its own portion into the slowdown that you will see in Q4. Considering that Q4 of last year was actually from a high base, so that will eventually still affect some of the near-term outlook. Looking at Q1, then we can start to see expectations for a gradual recovery from Q1, but that is still going to be impacted by our expectation for how coronavirus pandemic spreads in the first quarter. We are still seeing that slowdown in economic activity. Some sectors are still not gotten back to pre-COVID levels. And when you compare that where they were last year, you would also expect that it will also impact their results. So on a broad basis, I don't know if that suffices, or you want me to walk you through all the other parameters, or maybe we can just take that in another session from here, where we can get to address your questions even a lot better.
If you could just speak to monetary policy. I know that the CBN rose policy rates or changed policy rates like twice or so last year. I don't know, do you believe that they're going to start off the year on a new note, like just adjust policy rates again, just fix policy rates?
Okay,
and
so for policy rates, we still expect that the easy stance will be maintained until at least each one. And particularly one of the challenges with checking and with determining the stance of monetary of the monetary policy is because forward guidance from the CBN is not very helpful, particularly in helping analysts determine what the action of the CBN or the MPC is going to be. What we've seen or what we've observed so far is that there's been a lot more focus on sustaining economic growth versus the focus on price stability. So what we expect is that given that some of the factors that have been pressuring the economy are still very much in play, we'll still expect that at least till the half of next year, which is what we can see with a greater certainty, is that at least the half of the year we will still see monetary policy rates remain in an accommodative stance. We might not see the MPC, they have a number of policy parameters that they use to carry out their monetary policy tools. So far they've been using, in addition to tweaking the policy rates to I think 11.5 at the end of the year, we have other tools like they've been using credit as well. So credit is also one of the things that has been used to support the economy. So what we think or what we see is that not so much of a downside for policy rates. That is, we don't see them dropping policy rates further below 11.5, because at this point the benefit is not really the added benefit of doing that will not really reflect in output. But what we still see is that they might still continue a lot of their credit initiatives to boost money supply and eventually boost growth across sectors that need those credits. So that is what we see for monetary policy. I hope that answered your question.
Yes, thank you very much.
Thank you, Tolu. Thank you to all our panelists. Before we continue with our questions and answers, a poll will be launched now to enable all our panelists answer some vital questions about this Outlook event and how we can improve it further in the future. The poll is currently on your screen. Please answer all the questions. Okay, we'll continue the Q&A session with Baba Femi. Good morning.
Okay, I'm audible. Thank you very much. Once again, I would like to say thank you for this forum. Thank you for the analysis, global and local. My question goes to Mr. Junaid. You mentioned under the factors that are likely to shape the equity markets in 2021. And one factor you mentioned there is a change in the yield environment, and particularly made reference to the fact that we're expecting a special bills from the CBN. I just wanted to shed more light on what do you foresee changing in the yield environment? The special bill in question, I think they mentioned is going to be zero coupon, which means it's probably going to be at a discount. I can't really see any factor changing in the yield environment. The CBN governor's position, in line with this administration, their position is clear: push out as much credit. If nothing else, increase the amount of credits, increase the liquidity, in fact. So I just wanted to shed more light on that. What's, from your own vantage point, where exactly do you see in that yield environment that's likely presents a disruption to the liquidity situation, which is a key factor that is driving the equity market at the moment?
Thank you very much for your question. So let me make a bit of clarification. We are not saying it is going to change. We say there is the potential, and I will now explain on that further. Of course, like you mentioned, there are two competing scenarios here. On one hand, the bank wants to support growth, and we can see that through the aggressive intervention for sectors, target sectors. You can also see it in terms of how low rates have become in the fixed income market, all because they want to stimulate increase credit to the private sector. But we also have inflation that is getting out of hand. We are going back to the point at this rate where we were during the last recession, where inflation rate actually hit 18.72%. Before it started dropping. And if you look at it, of course, there are a lot of structural issues involved, but the amount of liquidity as well, the exchange rate component of it also means that there's still some part of it that policy can intervene on. For instance, we've been saying there is the debt of foreign capital flows into the market. Of course, when I'm looking at negative real returns, that is a disincentive for foreign capital to come into the market. And then you can also see how the high inflation is also impacting on other critical reforms in other sectors. They try to deregulate the downstream sector of the oil and gas industry. In December, the minister came out and said they were lowering the price by 5 naira. That's not the deregulation as we understand it. Also the increase in electricity tariff to make it cost reflective for the operators in that market. That too had to be rolled back because it will be too hard on the citizens. So you feel that, from a policy perspective, they are saying they want to stimulate growth within the economy, which is good. I mean, we are in the middle of a recession, and policies should also drive that. But on the other hand, we also cannot ignore the fact that inflation is getting into levels that is now hurting investments within the economy. A lot of investments are not viable by the time you do the benefit cost analysis, by the time, given the high inflation rates, because the rate at which we discount those investments feeds off the very high inflation rate. So projects that would otherwise be attractive will not be attractive, and capital will move elsewhere where it is more conducive. So because of that delicate balance, between letting inflation go on its own spiral while you're trying to stimulate growth, focusing on growth without trying to control inflation, at least beyond a certain point, will be counterproductive in the end of the day. And so there's that delicate balance that the policymakers would have to figure out this year. So that gives an avenue that, downside risk to the market. We are not saying for sure that, we see it happening in half year. In fact, our view, like I mentioned during my presentation, is that at least for the first half of the year, they will hold their position so that all the injections, all the interventions to try and stimulate the economy, see how that plays out. But this is not sustainable. The fiscal deficit is widening. We're not having inflow of capital. So which means there's always that risk that at some point they will have to actually focus on the challenge that inflation represents and tackle it. And if that has to be done, you can envisage a situation where rates could go up. If rates go up, it has implications for the market. So that is what I'm trying to say there. So there is that potential risk for the market. Thank you.
Thank you very much, Ahmed. I will take a few more questions from those raising their hands, but please make your questions very brief to enable us to take as many questions as possible. Zibo, please ask your question. While Zibo is getting ready.
Yeah, good morning.
Okay.
Can you hear me?
Good morning.
Yeah, good morning. Okay. My question is this. Last year, we noticed that before the lockdown, a lot of foreign FPIs left the market and the local investors took over the market. And we know the reason, because of fears of our society, really. Now, my question is this. Do you think the foreign investors will have that strong confidence when you look at the performance of the market last year? Do you think there is that confidence for them to return into the market at this moment or maybe this year? Thank you.
Okay. All right. Thank you for your question. Just like I highlighted during the presentation, the case for Nigeria from the foreign perspective right now is a little bit weak. You know, for foreign investors, liquidity is a major factor that decides their eventual investment decision. And right now, and like you also mentioned, given what happened last year, some were able to leave, but there are still a lot of foreign investors that are in the market and are not able to exit their position because of the FX situation. So you know that gives that's not it doesn't give a compelling argument for Nigeria as an investment case, you know, in terms of the foreign portfolio investments now. And then also the fact that the MSCI index, you know, they are providers of global indices that fund managers across the world track. And of course, there is an index for Nigeria, the MSCI Nigeria index. So what that means is that, and of course, we also have Nigerian equities on some of their other indices. So what means is that for global fund managers that are tracking those indices, they will not, even if upon review, they feel that certain Nigerian equities should be added to certain indices, they will not implement it because of this FX situation. So that gives you a kind of like thermometer about how foreign investors view the market. There was 50% return, even if you replicate it, but what is there if you're not able to get your funds out when you need to? You know, that is a major cause of worry. And our position is that the argument right now is weak. We expect that foreign investors will still stay on the sidelines. If the oil market, and you know this is a big if, goes on a rally, it recovers significantly. And don't forget that also depends on the outcome of the pandemic and all the efforts at vaccinating a critical mass of the global population. So if oil prices rebound, which is a major indicator for how for FX availability in Nigeria. So if that happens, which is it's not so, the case for that too is not so strong, you know. So that is the only thing that we might say, okay, maybe to change investor disposition in terms of FX availability in Nigeria. But for now, we are not seeing that. What we are seeing is foreign portfolio investors that are looking at Nigeria with a cautious eye because of the FX issue.
All right, thank you very much, Ahmed. We'll take Olade next.
Yes, thank you so much.
While he's getting ready, Elias, you can ask your question.
Yes, can you hear me now?
Yes, we can.
Okay, thank you so much for all for the presentation. The question I have, there was a noticeable trend last year where there's improved retail availability for Nigerians to play in, say, for instance, the US stock market, which never used to happen before. So I'm curious what your views are and what the industry charter is around the impact that will have on the Nigerian equity market in the short to medium, then to the long term. If a Joe on the street can access buying equities on the, say, New York Stock Exchange, and does not have to, how does that compete with the fact that the Nigerian equities has its peculiar challenges that you've eloquently identified? Thank you.
All right. Thank you very much for your question. So, I mean, one of the things that we've always said about the market is that it's not deep enough, that if you look across, essentially you keep pivoting back to the same set of stocks. And also, I mean, for the investment ecosystem, it's a good one. And you can see that a lot of financial services providers are also looking in that direction and hopefully provide more structure to how it is done as opposed to what's currently obtained. So I think that is something that is an inevitable trend or an inevitable event in the market. I think it will just happen. It's a good one, and I think we should all look forward to it getting more structured and more organized, so that because for now a lot of people are investing, but they have to do their own research. Some are not even doing research; they just know that, okay, this is a dollar investment. So I think we need to get to that stage as well. As for its impact for the domestic equities market, of course, what that means straight away is that domestic market will also be competing for capital along with those markets as well. But in the short term, it might not be significant because for a lot of institutional domestic investors, for regulatory reasons, many of them can't play in that segment of the market, and that is why even with at least for now, with the foreign the opportunity to invest in foreign equities, it's not been that impactful on the market. But if that happens, if they're able to get around that regulatory burden, then I think it could be, the impact for the Nigerian market can then be more intense if institutional investors start looking offshore. But overall, I think it's something that should just increase the competitiveness of the domestic markets as well in terms of governance, structure, regulation, and the likes. Thank you.
Thank you very much, Ahmed. We have Elias next. Please remember to keep your questions brief to enable us take as many as possible. Okay, Elias.
Right. Thank you very much, David and Ahmed. Very good presentations, to be honest. I think my question essentially marries both sections together. So, David, you gave a very broad overview on the impact of COVID, which I think was the most critical driver for local and global economy for both years, last year and then this year. What I didn't see was in the strategy bit, right? I was looking out for two things. The first was opportunities from the distribution and production of the vaccines, which you clearly mentioned that would span about 2 to 3 years. So I think there's value there, but I didn't see you capture that value in the strategy for 2021. So I'm trying to understand, do you have any investment strategy to capture value in that market that created for distribution and production of the vaccines, especially distribution in Africa? Then down to your focus on company portfolios. you mentioned the profile you described did not really layer on the performing sectors last year, which I think will be critical for an outlook for this year. So the performance of the sectors that did well last year during the pandemic, I think might just continue to do well this year. So is there like any linkage in your strategy? In these two bits. Thank you.
Sorry, sorry, I didn't hear the last sentence. You say, is there like what?
Is there a linkage between the investment companies you're looking at this year and the sectors that performed well last year?
Okay, thank you.
Okay, all right. So
okay,
let me take the question on the value chain.
Okay.
You mentioned, yes, you rightly mentioned that we did not, speak too much as to, the opportunities in the, from a strategic perspective, because so our focus largely on this presentation is just to highlight, where the trends are and just give a broader sense on, a broad sense on how the trends are supposed to, how the trends will, impact the economy, in subsequent periods. From a strategic perspective to, okay, so how do you now invest or how do you now capture value, in those sectors? Those are some of the things that we've considered in, I think we'll consider that as well in our strategy, which, Ahmed will speak to as to, from a company's perspective, how you capture opportunity in companies that play in that space and benefited from some of the trends that drove them, some of the positive trends that affected them in 2021. Yes, those are, those factors were also considered, which Ahmed will speak to. But from a broadly macro perspective, we're giving a guidance as to distribution and logistics will be most of the key areas that we would see that will require a lot of investment, particularly in getting infrastructure to be able to transfer those vaccines because of their specialized nature to the critical areas that need it. And a vaccine like Pfizer's vaccine requires ultra cold storage. Moderna's one is a little bit better, I think about -8 degrees, and some of them can be stored at relatively, fridge level temperatures. So yes, because of the demand that is going to, eventually take place, those are some of the sectors that you can rightly look at. But from a portfolio perspective, I think I'll just let him speak to that.
So, like you rightly mentioned, the kind of opportunities that that have emerged as a result of the pandemic and the vaccination. Some of these things are not the type that you can include in a portfolio of securities. For instance, they are like, how do I put it? They are for sector specialists, if you want to put it like that, or for institutional or maybe private equity investors to look at, and that is why you don't see them on this slide. So it's not like we are blind to those opportunities, but as to what is relevant for the sake of this presentation, that's what we have presented. I hope that helps.
Thanks.
All right. Thank you, Ahmed. Thank you, participants. Unfortunately, due to time constraints, you can take only one more question before we call up Abisoye to speak on margin lending. Okay, the last participant who will ask a question is Mr. Austin Okudili. Please unmute to ask your question.
Hello, can you hear me?
Yes, we can hear you.
Okay. All right, thank you so much, Ifunaya, for the opportunity. And thanks a lot to the team for putting this together. It's very insightful and helps us investors, more informed going into this new year. I just wanted to ask one question regarding the economic outlook on real estate. investing. And I know we talked about different equities and you know and how the macro economic situation affects them. I was wondering what if you guys had any insight on the real estate market given the current macroeconomic outlook going into the new year.
David, do you want to speak to that?
Yes, from a broader perspective, yes, we do have insights on the real estate sector. And, you know, when we talk real estate, we talk about a whole host of categories. And what you would see is the pandemic has impacted the real estate space in different ways. Each of those categories have, you know, they've been impacted differently. Take, for example, you know, if you're looking at, you know, corporate real estate, for example, you know, offices and the likes, those, the work from home strategy, the work from home, you know, style that has been adopted now would mean that, you know, demand in those areas are set to, you know, drop. While, you know, for some other areas, the impact is not really, you know, that's severe as we thought we would, like residential and the likes. But, you know, from depending on how you want to invest in it, there are I think there are instruments that, you know, mirror the performance of the underlying real estate, you know, investment that, you know, investors can still, you know, look at from a broader perspective. I think we have some, you know, real estate investment trusts, you know, and some other. I think we also have advantage portfolio and, you know, other assets that we also, you know, recommend that investors take advantage of to also gain the added level of diversification that, you know, real estate provides, because, you know, real estate is just one of those assets that offers you, you know, inflation edge, you know, it offers you, you know, that it's negatively correlated with some of all these other asset classes, so it can give you some the benefits of diversification to your portfolio. So yes, there are opportunities abound in that space. And as to how it affects the how the, you know, pandemic has affected the real estate space, you know, it's, you know, specific to each of the different areas that you're looking at. So I hope that answers your question.
Yes, absolutely. Thanks a lot. That makes a lot of sense. Also, just to piggyback off of that, so looking at how the pandemic has affected different sectors, I was wondering looking at like the tech industry. We know the pandemic drove some industries downwards, and some other industries kind of benefited from, you know, the pandemic, you know, to spring like a springboard to for growth. One of which I believe is the tech industry. You touched on the work from home. We saw a rise in like remote, you know, activities like Zoom calls and like more like remote workspace. And so I was wondering how you guys feel. Are you guys bullish or bearish on that moving forward in Nigeria? I know from a global perspective, it's been really some of the best performing stocks. So equity has been the tech stock. So I was wondering how you guys feel about that in the Nigerian space.
Okay, Ahmed or David?
So from the tech perspective, yes, tech sector has been one of the, you know, big winners of.
Hello, David.
Can you hear me? Can you hear me? Hello?
Yes.
Okay. All right, great. So I mentioned that the tech sector, they've enabled, you know, several aspects of our daily lives to be conducted remotely. Yes, and from a global perspective, they're doing well. And also, if you look closely at the Nigerian environment, you see that a lot more attention has been paid towards, you know, the tech space. Also here in Nigeria, with, you know, a lot of, you know, fintech companies, you know, starting to rise and, you know, receiving a lot of, you know, attention recently. The from an investor's perspective, if you are looking at, investing in any of those, companies, sadly, not a lot of them are they are public companies that, you can invest in. That's why you see that we didn't really capture some names, that you can, invest in on our presentation. But yes, the tech sector has, really benefited. We've seen e-commerce as well, with, telecoms as well as, also benefited, broadly from this. And given that some of these changes are, fundamental, some even last, after the pandemic. So you can expect that these sectors will continue to, record that growth at least for a while.
All right. Thank you very much, David. Thank you very much, Ahmed. And a big thank you to all our participants so far. It is important to note that in addition to providing solid investment advice to our clients, that we also offer a service called margin lending. This enables our investors and our dear clients to borrow funds at affordable rates. At this time, it is 12% per annum to invest in selected blue chip stocks. We offer this service to enable you grow your wealth and to ensure that you have the funds to do so too. If you have further questions about margin lending, please reach out to us at 0700 Meristem, as it is projected on the screen, or you can email us at contact@meristemng.com. Thank you very much once again. If your questions have not been answered, please type them on the Q&A chat box to enable our research team get to your questions before we end. At this point, we call on Sulaiman Adedokun, the Group Deputy Managing Director, for the closing remarks. Thank you.
Okay, thank you, Ifunaya. I would like to appreciate all our clients and prospects, every participant on this webinar for staying up to this moment in time. I believe it will have been it's been an interesting session for all of us. I also want to appreciate the team, the research team and advisory team that put this together for the job well done, for the insightful presentation. At Meristem, our brand promise is to provide up-to-date market information such that will help grow wealth in good time and in an atmosphere of transparency. There's no doubt that what we discussed this morning, every investor expects to get real positive rate, return on investment. What do I mean? That is return on investment that is above inflation. But unfortunately, we have been faced with a situation whereby for most of the asset classes, the real return has been negative. Every investors will be worried about this. So for us at Meristem, this webinar is very, very important as a means of providing insightful information, capital market expectation to our various investors, clients, and prospects. And the objective is to ensure that we're able to act proactively, to ensure that we'll be able to develop strategies, investment strategies that will enable us to achieve our investment objectives. And most importantly, also to execute such investment strategy. From the presentation, it is certain that there are a lot of uncertainties. There are expectations of volatilities. Ahmed mentioned the equity market being overbought, and at the same time, so presenting opportunity for investment on a relative basis when you compare to other countries. But the truth is, one needs to really understand this market to be able to, act profitably for the portfolio that, we have. So at Meristem, what do we want to achieve? for all our clients, we want to be able to ensure that we need to sit down, and discuss your investment with you. I'm sure there are a number of things that we would have expected for them to cover during the presentations. Some other alternative investments, asset classes that need to be mentioned that featured during the question and answer. People are discussing about the e-commerce, the pandemic-induced growth opportunities for some of those companies, like companies in companies in telecom, companies in tech, and these are growth companies that one need to key into. As an investor, there's a need to assess your risk profile before going into any investment. Bitcoin investment, real estate investment, or other alternative investments. It is very important that we have this assessment. And that is what we do as an organization, to assess your profile and to be able to provide advice on which investment strategies to adopt. And also, the environment, as mentioned, provide opportunity for many companies that want to raise funds and for a number of financial advisory services. So as Meristem, what do we do? How do we tap into this? How do we help you to tap into these opportunities? How do we help you? How do you provide such a service to you to ensure that you're able to capture the gains and the opportunities that is available in 2021? Definitely, one needs to look carefully before you invest. And time is also of essence. Investment timing is one of the key drivers of return on investment. So we need to be able to sit down with you to devise the strategy and the timing for the execution of such strategy. That is what we do. For many that have investments that span more than 2021, the objective is to see the impact of 2021 on your investment. It could be retirement planning, some long-term legacy planning, and other financial plans that we have. How do you ensure that the return on 2021 does not drag your investment target backward? And this is our job, this is our responsibility as a firm. The core objective is how do we take you further on your investment, on the process of growing with. That is value, adding value to that process, join you, collaborate with you, bond with you to ensure that we're able to deliver along this line. That is our objective. We expect both our prospects to also join us along this line. We've been designing a number of creative products, innovative products to ensure that we're able to key into this opportunity. There will be further analysis by the team to detect more and more opportunities, meaning that, as one of the presenters said, there's a need for a real engagement, discussions, and further drafting of IPS, investment policy statement, with some of our clients. This is the time to actually sit down with the wealth advisor, Meristem wealth advisor, to devise that plan and continue to monitor such. Rebalancing is very important in 2021 because of volatility that we have mentioned. There's a need to rebalance regularly, as suitable, and because of some volatilities, policy reversals, and some things, macro effects that will affect portfolio. We need to be able to be on top of this and to keep top of it and to ensure that they do not actually impact negatively on our investment. Every investor, as I said, what we are looking for is value. And what we stand for at Meristem is value. We stand for engineering value towards that will impact on your portfolio and will take you to the next level. We thank you for the opportunity for all our clients. We thank you for the opportunity that we have for making it possible for us to have manage your investment. I also look forward to us doing many more for many of our clients. Thank you for attending this session, this webinar. Thank you, Ifnaya, for the brilliant coordination of this program, and to the team and to all our clients. Please, COVID-19 is real. We need to just stay safe. I pray that we'll be able to witness many more Outlook presentations in our life than this 2019. And all of us will outlive this COVID by God's special grace. Thank you and God bless.
Thank you very much, Sulaiman, for that wonderful closing remark. Thank you too, and God bless you. We have come to the end of this Outlook event. We hope it was impactful for all participants. If we have been unable to answer your questions, please reach out to us at contact@meristemng.com. We have to end now. We wish you a beautiful week ahead. Do have a good day. Goodbye.
You've reached the stars, now let's see you conquer galaxies. You've gone for gold, let's show you to.
What kind of success do you look for?
No gold.
If it's the small kind, you can go at it alone. If it's huge, no matter how good you are on your own, you need partners. Partners who can help maximize the potential of your wealth. You've come this far, let's take you further.
Meristem, let's grow wealth for you.